Mr. Hanna, you're able to do drugs during the day and still function, still do your job?
Well, how the fuck else would you do this job? Cocaine and hookers, my friend.
Here we are at the end of another trading week, and we are getting ready to wrap up the month of September. So, whether you believe it or not, yeah, time is still moving forward. And for those of you who don't know, but we are now less than 100 days away from Christmas, right? Actually, 97 today. How do I know? Well, because my girlfriend, she's one of those which start to count the days away from Christmas when August ends. I don't know why. I personally don't agree with that. I actually find it annoying a little bit, but it is what it is, right? So that being said, let's jump into what the week brought as for the economic calendar. Of course, it was FOMC week. All as expected. Nothing really changed or no surprises there. So, the week was kind of like what you could have expected looking at the economic landscape and the rumors and the news. So we got to start out the week the Empire State Manufacturing Index, which tanked a little bit. Nothing, I mean, nothing crazy. It's been in this range for 3 years now. We just mean reverted back again. So I wouldn't say that's particularly you know, worrying for me, or at least, it's not more worrying today than what it could have been last month or 2 months ago, right? Just again, maybe if you want to find at all cost some sort of a negative reading to it, it's just that manufacturing it's not picking up, right? No matter the policies, no matter the bring back manufacturing type of claims. And again, I already mocked on Lutnick 2 weeks ago, I think. It could take time. We don't know. We'll see about that, I guess, and time will tell. Moving along, we got retail sales. Now, retail sales actually, they surprised to the upside. The consensus was for a 0.2, point 0.2, so 20 basis points. It came in at 0.6, point 0.6, so basically 40 basis points higher. It's not, again, it's another one of those things which, in the moment it looks like, look, we are we are seeing an increasing in retail sales, but if you zoom out a little bit and you look at the last 3 years, if anything, it got maybe a bit more volatile, but I don't really see a new trend emerging. Now, you might look at the year over year type of data set, and even if it looks like it's trying to pick itself up, I'm not totally convinced that it is legit. Now, again, I also have my reservations on retail sales because it's a nominal type of data. It's not adjusted for inflation. And again, even inflation, right? If you remember the previous week, as measured by the CPI, it surprised a little bit, right? I mean, it ticked up a little bit. Not that it was a complete surprise. It was actually expected, but the question is always the same. Are retail sales, which are nominal, going up because people are just paying more and buying less of what they would like to buy? So again, is it a bad thing? Is it a good thing? Right? Uh, if you want to look at the bright side, it means that consumers are not completely tapped out yet, and they're still able to spend. On the other side, it just means they're paying more and getting less. So, at a point, this type of a dynamic might get exhausted. Just for the sake of it, if someone would be interested in what goes into this data point, retail sales, this is the composition of that. And for this month, what you can notice is that the majority of the upside contribution came from this tiny little thing right here, non-store retailers, which quite honestly, I don't know what that actually means, but you know, there might be some nerd out there which could figure out what it is and if it could be, relevant to a lesser or a much higher degree. I'll let you be the judge of it. One thing that I do know though is this one, right? If you look at the recent surveys, right, from the University of Michigan, this is basically some sort of a sentiment read on the probability of losing job. So, you see that every time that data point to the upside, these dark blue line right here, every time it picked in the past, after that we have seen retail sales actually coming down. And it could, it doesn't have to, but it could, right? It's right on the spot where it could be a new high as for the probability of losing job sentiment grasp. And this time around, retail sales, although again the data recently was positive, or you know, it was looked at under that perspective. But if it is a peak right here, and this data point in a yellow, no yellow, in a light green should be moving lower, that would be moving lower from a low point compared to the previous iteration. So again, uh, is it all rosy when you look at the data, under that perspective? Again, maybe you should be a bit more cautious, I'd say. And again, if you pair that up with, the unemployment rising again, uh, you know, how does it bode for consumers' willingness to keep on spending, right? So again, I'm not saying it's a complete negative data. I'm just saying you need to take it into context, all right? And then what we have is that the unemployment rate, as measured by the U3 type of data, just ticked above its 36 months moving average, which in the past actually led to recessions. Now, this time around, I guess, I mean, if you see back in the past, uh, the recession came in actually immediately after, the data set printed a few points above the moving average. Could it be different this time? Or could it be kind of delayed? Or could it be a lag? Maybe, but it's also true that you do have this gray shaded area right after what 9 to 12 months after the fact, as declared by the NBR. So it's just maybe a warning sign, but you don't have confirmation up until the point those genius at the NBR would tell you 1 year later, oh, by the way, yeah, we went into a recession back then. So at that point, it's kind of useless, right? And you know, pairing up retail sales, potential labor market sentiment, and what we looked at before, the manufacturing sector, what you see is that it looks like manufacturing jobs are still contracting. And if you look at the charts, they are basically contracting over the last 4 months. So again, think what you want, right? This is not a political type of a judgment, but it's just to show that one thing is claiming that you want to do something, another thing is actually being able to realize it. Again, I don't know how the future will be, and I personally don't care if it's going to be under Trump or if it's going to be under the next president, that the manufacturing jobs are going to pick up, and people in the US will feel a little bit of a relief. It's not up to me to decide, and it's not up to me to judge. I'm just showing you the data. And so sometimes uh, to clear out the air in between the noise, the words, and the news, and then what the actual results in the real economy are, right? But again, after these parentheses, let's move along. Now, we also had the industrial production month over month, which again, it's kind of ranging. It's not tanking at the very least, but it's still ranging. It's a bit more positive if you look at it year over year. It looks like we kind of jumped to a new level. Up until the point you do realize that level, it's basically hovering around the zero line and the 1%. But, still, in 2024, we were struggling to stay positive. So I guess, that should be taken as a, as a plus or as an improvement, I'd say. Probably not a substantial one, but still better than being negative, right? Then we came in. I mean, this one wasn't on the calendar, but I wanted to check this out. This is the capacity utilization type of metrics. Now, why could it be relevant? Well, because it's just a measurement of realized output versus potential output. So you look at the industrial complex, you look at at the miners, you look at the utilities producers, the industrial sector or the manufacturing sector as a whole, right? Let's put it this way, and you establish that at a normal type of operational regime, they could output, let's say 10, for the sake of rounded numbers, right? But you do realize that instead they are running at a pace of what, 7.7. So you might wonder why there is this gap in between the potential output and what they're actually putting out, right? And the answer is that when you have some sort of a underutilization, right? That means that maybe these guys in the real economy, they are looking around and they see there is no demand or not enough demand to justify full utilization, right? And therefore, you pair this up with other things like, um, hours worked or average hourly wage, right? And you do realize that there is a reason and there is a tie in between what you see in this chart and what you see in other charts. And it's still pointing to a weakening labor market, a softening labor market, right? So, 77%, it's not totally bad. I mean, if you really zoom out, what you see is that we got into trouble when these data set actually got below, I would say maybe 75. That would be a good metric, maybe. Like we got the pandemic, of course, it went below 75. '08, it went below. We got some sort of a trouble in 2015, it went below. After the dot-com bust, it went below. And of course, at the beginning of the 80s, we had a recession, so it went below. So, I mean, again, it's another one of those data set which is hovering around the survivalship line, so to speak, right? And we finally came into the big day, so FOMC day. Now, as expected, they cut 50 basis points, what the market wanted and what the market was expecting. And, if you check, the stock market actually rallied upon it. And, beside the intraday volatility, the market kept on trading the way it was trading before, for the most part, right? For the most part. Now, key takeaways out of the FOMC press conference. Yeah, I took the time to watch it, but just a little bit of a recap. Now, I don't have, of course, the dot plot below it because I didn't want to talk about the dot plot chart. To me, it is what it is. I'm not following it religiously, but there are other few points which, in my view, could be relevant to bear in mind getting into the next week or getting into year end. All right. So first of all, Powell highlighted the shift in the downside risk in between inflation and unemployment, right? And then what we've seen is that he finally acknowledged the fact that these tariff-driven inflation, well, it didn't show up yet, and it might be, as he says, that it could be a one-time event. All right. Sure, they're going to monitor it and they're going to see if there is a much higher risk. But, after all, if in a few months we didn't see any type of tariffs inflation, uh, you know, type of spike, maybe we could kind of catch a breath here, right? Now, he noted that, where was it? Oh, yeah, this one. The Fed was expecting the employment revisions, right? But it's still concerned about the low response rate in the surveys. This is kind of tricky because, if you were expecting the revisions, right? Since when were you expecting them? Because if you were expecting revisions back in July, maybe you didn't expect like 900,000 jobs to be revised to the downside. But if you still were expecting some sort of a revision, why didn't you cut these 25 basis points in July? I mean, right? And again, as for the low response rates, this is something which, again, it could. I mean, it depends how you want to see it. If you want to think badly, you could say it's political a little bit. I don't think it is necessarily political, but it's just a fact. The point is that there is a point for the BLS. They have been underfunded. Financial resources to them has been cut starting back with Obama. So it's not something which is necessarily on the right or on the left. It's just a fact. They didn't receive the same amount of funding, and so they didn't have the same amount of means and tools. And if you check, a lot of these surveys that were once upon a time conducted locally or regionally, they are now all centralized in Washington. So it's natural that you are going to lose a bit of accuracy if everything is run at a centralized level. You kind of get out of touch, quote unquote. All right. So I guess that is the problem with the BLS. And the thing is that on one side, you see Trump, which is declaring now that he wants to decrease the funding to these institutions of another 8% in the next fiscal year. But then again, he's moaning about the fact that the data is not accurate. So yeah, I mean, maybe they need to reform it. Maybe they need to change the models that they're using at the BLS itself. But whichever the case, something needs to be done because at the end of it, it's too easy to go through all these arguments and then concluding that Powell is an idiot because he didn't cut rates before, but still he was kind of running on flawed data, right? Although he was expecting the revisions, right? So again, I mean, it's hard to put the blame on just one person in this entire mess at the end of it. And, you know, at the end of it, Powell said, it's not obvious what we need to do. No shit, Sherlock. I guess, that's the best thing you could have said because just check back history and see what you said recently. So there wasn't a problem with inflation. Then there was a problem with inflation, but it was transitory. Then it was less transitory. And then, in order to fight it, we should have stayed higher for longer. But then again, when you keep on saying higher for longer, the bond market starts to contradict you, and you see yields, getting from 5% back down to 4.4, 4.6, 4.5, and starting, if you look at the 2 year ahead of these cuts, there was like 50, 60 basis points of a spread in between that and Fed funds, right? So again, and now you started to, going off the tangent of tariffs-driven inflation, but after what? It was April, and then we got May, June, July, August. After almost 5 months, we don't see that inflation. So now you say, yeah, it was inflationary, but maybe even if we will be, because it didn't, but it wasn't yet, maybe it will be a one-off. And now, you know what? I don't know what to say. Too many factors at play for me to actually say something about it. So, yeah, I mean, again, whatever you want to think about Powell, but I think again, although I do like to make fun of him, but it's not an easy job, all things considered, right? So I have a little bit of a sympathy for the man. Now, let's try to wrap it up. Now, jobless claims came in at 231. So there was, the spike that we've seen last week, and it immediately cooled off. Overall, if you look at the continuing jobless claims, they are still running at a elevated level. Same as we did before, if we really zoom out, let's see what could be the magic number on this chart to say things are actually going bad. I was eyeballing 2.5K because I think, going back in time, looking in the 70s, when it starts to go above that line right here, we had a recession. At the beginning of the 80s, actually, in between the end of the 70s and the beginning of the 80s, we had two recessions pretty close together. And again, we were, of course, above the 2.5K mark. Then at the beginning of the 90s, we had another type of financial stress, economic contraction. And again, this number pops up. Dot-com bust. We started to get above the 2.5 in April 2001. All right. 2008, uh, we were hovering around 2.5 already in the middle of 2007, and it was just snowball from there. Then, of course, COVID, but COVID, it's some sort of a big outlier to me. So, just to say that we are still right around 2000. So, I guess, yeah, it's not cool to see the trend, but maybe we are not really, you know, tapping into the breaking point, right? If you want to shine a positive light on the entire thing right here, which again, to me, it doesn't look right. It doesn't look cool, but maybe it's not bad enough, right? Let's put it this way. We ended up with the Philadelphia Manufacturing Index, which again, it just tracks the Philadelphia region. So it looks like it ticked up. If you look at the last 5 years, though, yeah, we didn't recover the type of a drop that we had in 2022. So maybe not, not conclusive yet. All right. With all of that, we have seen what? We have seen the break evens ticking up a notch, just a little bit, but still in this range. We have seen PCE. And talking about PCE, we are going to have a new PCE data point next week on a Friday. So be on the watch for it. Still around 2.6% standing to trueflation. CPI, it's now around 2.2, so still below these highs. Doesn't look like it wants to really run for now, at the very least. And it's still running around what? 20 basis? No, more than that. Maybe more than 50 basis points below the establishment CPI. So again, we'll see about that. It is also true that this is very volatile, and every day you check in, it's a different number because it's updated in real time. So but I like to be more focused on the trend at the end of it. GDP now it's still estimating a 3.3% GDP for the third quarter to be around these. I mean, the Fed just said, Powell just said at the FOMC press conference that the estimate for the entire year, 2025, are actually around 1.6. I guess they were revised up from 1.5, if I remember correctly, or still, I mean, at least in that ballpark. So I mean, yeah, you could have a quarter, which is a bit of an outlier, but these type of metric right here has always been volatile in my view. And I do remember when it was basically all over the place when we got the tariffs and the Liberation Day and all the rest. So I wouldn't put that much weight on this one. And I guess on this one, I would go with what the Fed is actually projecting. It's kind of pointless to look at a Fed watch tool at this point because it's too early. We got another 5, 6 weeks before the next FOMC, so kind of pointless, right? So that was the week as for the economic calendar type of a perspective. Maybe just one more thing. We've seen on Wednesday we got, anticipating uh, the Fed cutting rates. You look at the 30-year mortgage rates, right? Which actually decreased, right? But don't believe that the impact of Fed funds on 30 years mortgages rates it's going to be huge. They don't really control that part of the curve, right? If anything, I think the decrease could have been due to what we've seen in the housing market, which again I don't follow a lot sporadically, and I don't waste a lot of time to talk about it. But look at the building permits, right? Down. Housing starts stagnant, if not down. I know these are preliminary data, but it's really not. It's not depicting a rosy picture for the housing market. And again, the housing market, whether you like it or not, it's a huge component of the overall. It's a good chunk of the economy in the U.S. So don't discard that, right? Now, let's wrap this section up and let's move into the charts, shall we? As for the charts, let's start out with currencies as usual. Now, this was interesting, all right? And I'm gonna try to tie these in with what happened in yields and treasuries. So at the beginning of the week, I think it was on Tuesday, it was, yeah, September the 16th, maybe. Yeah, the day before FOMC. So I was looking at these charts and, let's start out with the DXY. The DXY was attempting to break the lows, right? The euro was breaking out with this massive extension if you check the daily candle, right? And we had yields which actually ran like a lot to the downside, right? Ahead of the FOMC. Okay. Now, this is interesting because everything actually started out for me with the yields and the bonds. So to me, yields were particularly overextended to the downside. So you could call it oversold, right? Then I checked the Treasury futures, and what I noticed is that there was this tiny little bit of a divergence. So the 10-year note was making lower lows, while the long end was making higher highs, and even the short end was making higher highs. So one type of a breaking correlation there, which is the same that you see me tracking on yields over time. I don't have it on this chart, but if you want, you can see that it's present on these two as well. I mean, on these three. Just that this time around, it's actually the 2-year being in disagreement with the rest. So my thought was, and again, this was confirmed right ahead of FOMC, basically. So my point was, okay, if yields just ran to the downside too much ahead of the news release, that means the news is priced in. So the most logical thing to have is a little bit of a mean reversion play. And therefore, this inefficient move to be filled in, to be drawn back, right? Some sort of a pullback into it. If yields actually pull back and so they bounce, what you should have, it's treasuries coming down. And you have a confirmation that the 10-year will be the weakest. So since I own, or I used to own a bit more, but I actually sold a good chunk of them. But since I was owning a bunch of 10-year notes, I said, you know what? I'm gonna set them right on a Tuesday and see what happens next. Just to the risk, right? You know, could call it some sort of a take profit or a rebalancing type of a move. And then, if you think yields are gonna move to the upside, you know that the short-term correlation in between the yields and the dollar, right, against its peers is actually positive. So I said, yields up, that would drag the dollar higher a bit, you know. And when you check the DXY chart, let's look at it this way, right? When you check what was going on, you see that that was a perfect spot for a swing failure, right? The sentiment was kind of bearish, or if not totally bearish, because we have been hearing for months that the US dollar is fucked. It's gonna lose reserve currency status and all the rest. But I mean, I'm not saying that this is going to be the low for the DXY and it's going to be upside only from here. But I'm just saying, when you start to put all the pieces of the puzzle together, I couldn't think of anything else or anything better to be some sort of a trap than this low right here. On news-driven event with a very bearish sentiment and everyone kind of on the same side of the bus if you check the positioning because there is a massive short on the US dollar. I guess it was a perfect spot to catch a lot of people off guard. So after selling the treasuries, what I did it was actually to sell the euro while it was spiking to the upside. And again, I don't know how it's gonna go over the next week. I might be forced to swap back the positions, but I sold the euro to buy back the dollars, right? Now you might say, what are you gonna do with those dollars? I don't know. I could use them to buy more treasuries if they pull back enough, and I find them particularly cool to buy back in, considering that the Fed already, they left the door open for further rate cuts into the future. So this should be going up a little bit more. I'm not saying it should be going parabolic, but should appreciate a bit more, right? Or I could, if at the end of the day the euro starts to bounce in here, I could just swap it back into euros if we start to reclaim the 1.18 mark, right? Still, would be end up in a in profit for the trade alone, and I would keep on riding the euro appreciating against the dollar. So we'll see about that. I don't know. It just felt like the most obvious thing to do when I was looking at it on a Tuesday. So again, this is how you can frame, because many people ask me, yeah, I mean, all this macro stuff, but at the end of the day, it doesn't really give you anything actionable. And this is just me saying, I beg to differ, sir, right? Okay. Now, as for the rest, JPY stayed relatively weak. And again, we tapped back into this trend line. We have been looking at it for a long, long time now. And we just got back into the range. So still weakening yen overall, right? Now, the rest is kind of unchanged. The British pound actually followed what the euro did to a much, greater extent, I'd say. Was much more volatile, but that such is the nature of this pair compared to the euro, right? And as for the rest, what you see is that Chinese yuan is strengthening against the US dollar still. Same for the South African rand. The ruble keeps on drifting to the downside. Yeah, I mean this week was particularly stable, but still, I I don't look at it. I don't think this is showing strength, not yet, at the very least. The Australian dollar, after the breakout of the structure right here, it's pulling back a little bit, which again, don't you find it strange, right? Yeah, I mean, the DXY actually bounced, but wasn't expecting this sort of weakness in the Aussie dollar. Maybe a little bit of a pullback, but I mean, these 3 days were particularly brutal, right? So we see about that. The Brazilian real keeps on being relatively strong, kind of like the Chinese yuan against the US dollar. So we'll see where it leads, right? Now let's have a look at oil. Oil, yeah, another two tape type of week for oil. It was up on Monday, Tuesday, and then down Wednesday, Thursday, Friday. So I mean, again, I don't think you could make a big case for oil at the current moment in time. Like, I mean, unless you are trying to factor in mid to long term views, for now, in the very short term, it's just consolidating. There is this ranging behavior. I keep on adding to it my, usual bearish bias because, yeah, fundamental reasons behind it. But quite honestly, it's just in some sort of a limbo right now, right? Up until the point it doesn't actually break the support to the downside, or it can break out to the upside from this failure right here. I would say it's deemed to be range bound, right? So not a lot to say on oil, I'd say, right? Let's have a look instead at gold. Now, a little bit of a different chart. This is actually spot gold, right? And I was still looking at the same type of extension I used on futures, right? But just to, let's try to zoom out a little bit. Why did I want to sell gold this week? And I didn't have the chance because price actually didn't reach up into the level I was looking for, which was, of course, the Fibonacci extension right here. Whether you believe it or not, or whether you believe this is the right way to draw these extensions, right? But I was also looking at the long-term type of a channel that we got. Now, you might say, okay, but since you have some sort of a midline right there, you could actually split this channel in two, and maybe the lower channel, right, the lower half of the channel is what really stands out, because you see that it really starts to go to the upside when this channel right here, the lower part of it, is established, right? Rejection at the mid, and then it's been picked up at the lows, rejection at the mid, and then it's picked up at the lows. Then we finally break out of the midpoint. It uses it as support 1, 2, 3, 4 times. But I like these some sort of how do you call it, this alignment right here in between the upper side of the macro channel, right, and the extension. So I'm still trying to wait if we can hit this pocket right here, which would be in line with price action poking above the long-term channel. And for me, it would be a good place to actually unload a bit of my holdings of gold. Uh, do I think gold is going to reverse from here and it's going to be downside only for the eternity from there? No, I don't. But it's just another measure of overextended. As in, like, if you check back, if you see something which is trending like this, you could always kind of de-risk when it approaches the upper band of the channel and adding back when it approaches the lower band of the channel. And you keep on doing it up until the point the channel doesn't break one way or the other, right? So in this case, if you do imagine, right, even if you, like me, even if you do think it would be wise to the risk and to take a bit of profit at this level right here, if you extrapolate this channel to continue in the future, kind of like that. I know maybe it's not perfectly in line, but if you just imagine this keep on going to the upside, and same would go with the midpoint of it, right? I would say, when would you say the trend is broken? Well, two things. First, I do like these sort of a overall structure that we build up into here, right? So the consolidation, which led to the breakout, right? So I would say up until the point I don't see gold doing something like this, right? Let's say comes back down. Now, if it breaks these lows, so if this consolidation, if this shelf, macro shelf actually gives in, and at the same point, the timing of it actually coincides with the break of this long-term trend line, at that point I might say, you know what, maybe I really need to reassess my mid to long-term view on gold. But up until the point it doesn't happen, I'm totally open to the possibility that we just, maybe tap into it a little bit. We pull back, we draw back this inefficient leg to the upside. We come back into here, we do reaccumulate, and we try again higher. So again, and again, these, it would be in line kind of like with the midpoint of the entire long-term channel. It would be some sort of a retest of this consolidation, right? Does it have to happen exactly this way? I don't know, right? I don't know. But it's just some sort of a reference point, something that you need to have in order to draw a little bit of a line in the sand and saying, okay, at this point I'm right. At this point I'm start to be wrong, and I need to reassess what I'm doing here, right? So that would be it for gold. I mean, I don't necessarily think there is a lot more to say about it. Uh, the alternative, the other scenario, since price action can only go up, down, or sideways. So the other scenario is that we completely break through, smash through this level, and we keep on rallying. At this point, I would say if you break out, I mean, if you just overshoot this one, chances are increased for gold to actually reach into the 4,000 level. I don't know. I like to take things one step at a time, so we'll see. But that would be the natural continuation of this trend, the next relevant big figure, so to speak. I think if you check back in the past, when gold starts to run, it tends to run for months, if not years. Same as when it starts to to consolidate, like you can see in here. We're talking years, right? So still maintaining a bullish outlook on gold. The technicals are still there. Fundamentals, I think, are still there. So I'm still sitting very comfortable in my gold backs for now. Let's have a look at Bitcoin. Now, Bitcoin actually tried to break out to violate this wing high right here, which in my opinion, as I discussed recently with one of my dearest friend, at least on the internet, right? This was, or this is still, the swing which to me needs to be, taken out or closed above and sustained above in order to open the doors for new all-time highs. Because this swing right here, first of all, it was put in on news. If you remember, I think I don't know if it was when Trump was talking about establishing a Bitcoin strategic reserve or something like it, but there was a massive spike on news, I do remember. Probably it was right, that one. But anyway, from a technical analysis standpoint, from a structural standpoint, this is the swing which actually leads to the break in market structure, right? It breaks the structure right here. And then as you can see, the market is unable to reclaim these structures lows right here. It tries one time, two times, and then finally it got back into this previous range. But still, up until the point, it's it's just confined in this previous dealing range right here. You can't be over optimistic. Now that doesn't mean that you should be pessimistic. I'm just saying neutral, right? I mean, price just reclaimed the previous dealing range. So my assessment would be, look, up until the point we are below here, but above this one, I'm neutral. Slightly, I would be slightly leaning toward the bullish side because of what we are doing now. So, now we are making higher highs, higher lows, higher highs, higher lows on a daily base. If you really want to, I mean, what's that? Is that a bottoming pattern, some sort of a head and shoulder right here? So did we put in a low with a commonly known type of a pattern? Maybe, maybe not. I don't know. But again, it's a risk on asset, right? So up until the point you see other risk on assets like the stock market performing particularly cool, I think, you shouldn't be too much worried about Bitcoin breaking down. It could, and we will assess that when, at the very least, when we start to crack back below 113K, right? Up until that point, I think you should be neutral, and if anything, a bit more tilted to the bullish side of things. Still, I do like to see these dynamics right here. I mean, everyone was kind of getting a little bit ahead of themselves, and then what you get is Bitcoin, just sneaking above the level, closing below, swing failure pattern, and immediately dropping back like what? I think it was a good 2%. Yeah, I mean, which for Bitcoin, it's not a lot at the end of it, but it's just, it's the more and more it goes on, the more it starts to show dynamics and movements which are more commonly observable in traditional markets, which again, to me, it's just testimony of the fact that participants have just changed in these environment. To me, it's actually a nice thing because I think it's going to be even more funny to trade for those which are actually trading it, and maybe a bit less funny for those which are holding it, hoping that it's gonna make 200% in a year, right? I mean, I'm not saying he couldn't make like 70, 80, 100% in a year, but maybe the crazy numbers that we were used to back in 2017 or 2019, maybe we won't see them to the same degree we were used to, right? Take it or leave it, I guess, right? The good thing is that at least it's now a legitimate type of a financial asset, and it's here to stay, right? Now that being said, let's have a brief pause, and then we are going to look at the stock market and a few things which, again, as I hinted at last week, could be kind of worrying in the event of some sort of a credit event, liquidity event, or generalized type of a risk-off scenario, right? So equities, let's have a look. Let's zoom in first, right, to see how the week actually developed itself. We started out on Monday, as you can see, and I know I'm always pointing at the ES futures, but at the end of the day, it's kind of the same for the other market, right? So where was I? I just lost my train of thought, I guess. Yeah, and I lost the chart too. So now here we go. So it started out on Monday, right? After the huge pump on a Friday, as for especially the S&P, um, we just kept on accumulating and pushing to the upside on Monday. At least for ES and NQ. The Dow, since it actually anticipated that run, needed to draw back the leg a bit more before actually starting to following, right? So it was, the Dow was leading in here, and then the other two catched up, and the Dow was, drifting down, just exhausting these huge move to the upside, and then at the end of the week it started to catch up with the other two moving to the upside, right? So just bear in mind what I'm describing on the S&P and the Nasdaq. It could be a bit out of line with the Dow, but just because, again, the Dow had this massive upside day on a Friday last week, right? So getting back to it, Tuesday was a little bit of a pullback day. We opened up for the overnight session in Asia. London pushed higher, and then we've seen in New York draw, a good drawback, a good drop at the beginning of the session, and it kept on consolidating around these lows. Then again, we got into Wednesday. The market was particularly quiet, kind of consolidating in this range, not really breaking out up until you got FOMC. Of course, volatility picked up the pace. We've seen this massive push to the downside. So ES, again, kind of like the Dow, rebalanced the huge leg of the previous Friday. And from there, we kept on pushing to the upside. Um, we did kind of the same. Thursday was kind of the same of Tuesday, up in Asia, up in London, and the rest of the US session was just consolidating up and around. And again, finally on a Friday, we went for a bit of a strong close, right? I mean, how do you define a strong close? I like to think of it when price action actually close in relatively near the current highs of the day, right? So it's much more prominent on NQ. It's a bit less prominent on ES futures, but when you zoom out, it's hard to say that this wasn't a very good close for the week. And what you see at the end of it on the daily time frame, it's just the FOMC drop was just at the end of the day a blip on the radar. And it originated some sort of a what? A hammer, a doji, call it what you want. It's just rejection, right? On ES futures, we just filled in this gap in delivery right here, and then we kept on pushing higher. Now, I actually didn't notice before, but I don't, I'm not a particular fan of this flat bottom on the daily right here. This is just because, often they tend to be traded back into. It's not always the case. Like, for instance, you see that we didn't have the market trading back into it right in here, right? Both for ES and, yeah, to some degree, even NQ shows the same signature. I'm sure if you zoom in, maybe it's not really a flat bottom, at least on NQ, it looks like. On ES, it looks like it is. But again, look at this one right here. When you have almost no accumulation below the open, from time to time, uh, the flat bottom becomes a draw on liquidity. And as you can see in here, we had to test back into it just to then keep on trading to the upside, right? I think again, we have been discussing a lot of potential risks for the stock market. We've been discussing the seasonality. What we've seen is that although August and September were historically two of the weakest months for equities, uh, it looks like this time around we defeated the statistics, right? Assuming we don't have a massive pullback in the next week, which would be, I think, the last week of September, most likely. Well, I mean, we are going to have, yeah, another Monday and another Tuesday to wrap up the month, but I think the majority of it will be put in next week. Before getting into other considerations, let's have a look at the other type of a chart that we usually look at. So we were discussing the price action was a bit deviated even compared to the 21 exponential moving average. Could you call this drop on FOMC uh, like some sort of a mean reversion toward that moving average? I I don't think so necessarily because uh, I would I mean I would think of it more of something like this when you actually have closes around the moving average. Since again, the moving average is established on closes, right? So just a week intraday, I don't necessarily think that there is proper mean reversion. Then again, if you tell me, well, but maybe the market is so bullish that as soon as the price just approaches those moving averages, you got CTAs and algorithms kicking in and starting to beat the market higher. Yeah, I mean, yeah, that could be. I'm just saying, in order to have a proper mean reversion, I would like the market to actually close around those moving averages, right? As for the rest, the market is fine. I mean, from a technical standpoint, that there is nothing wrong with these markets yet. Is it a bit extended, especially when you look at the Nasdaq? Yeah, it is, right? So that always leaves the door open for a potential volatile move intra-week to kind of rebalance the extended posture of the market. But overall, it doesn't really change a lot. Even if we get there, doesn't really change a lot for the overall trend, right? So I would, just from a TA standpoint, I would keep on being bullish on this market. And there is, I mean, again, there is no reason to be bearish yet. So it could also be right. We have seen that August and September were particularly strong. So you could also build up the case if we defeated the narrative and the statistics in August and September, what if we defeated them for October, which should be a good month. So what if that one is going to come in differently this year, right? So you never know, right? The statistics are just there to give you some sort of a guideline. And again, don't discard the fact that at the end of it, August and the beginning of September, you didn't really have that sort of a correction, right? We were talking about a potential 6 to 8% correction. We didn't get that, right? But we did have a little bit of a sideways action. And remember, when you are overbought, as we said in the past, the market can actually work off that overbought conditions in two ways. Either you have a sharp pullback, or you just have the market going sideways up until the point all the oscillators, right, they cool off a bit before resuming the run up. So you know working off overbought conditions, it doesn't necessarily imply a sharp drop. That's usually the most quick way to work the conditions off, right? But it's not the only one. And I guess this time around we went for the other route. So again, still, at the end of the day, we had a positive outcome for markets to the upside. So now, let's have a look at these just quickly, which should reinforce the bullish thesis. These are the amount of buybacks which have been announced recently. So again, you see that we are really pushing when it comes down to these. If you notice, this week alone, I think it's not properly a buyback, but I've seen Elon Musk on a Monday. He bought back I don't know how many billions of Tesla shares. Um, if you just want to look at the news, we have seen like Nvidia buying up a good chunk of Intel right after Intel was bought up by the US government. So uh, it's one of those dynamics where I think when the market sees that, the market just think it gotta be bullish, right? There is no other way around it. It's gotta be bullish. If a giant like Nvidia, it's kind of saving up Intel. I mean, either there is more to the future of Nvidia, which it feels so strong that now is expanding, acquiring what before could have been competitors. If now they are acquiring them, it means they do have plans for the futures, right? So again, the market could take it as a positive thing, both for Nvidia and both for Intel, because well, if you thought Intel was fucked, then why the U.S. government and Nvidia are actually buying, quotas or parts of it? And again, I know the first and most obvious question, it might not be the right one, but still, it's better to see things being bought up than being sold off, right? So it just, I think it's just fuel the bullish sentiment overall, right? Um, we have seen also that consumer credit actually jumped. Now, this is not necessarily tied in with the stock market. I guess it could correlate a bit better with what we were looking at before with retail sales, right? But I do also think it's some sort of an insight in margin depth, right? Now, I do know margin depth can be used for many different things. It's not cool when you use debt, aka your credit card, to buy the food that you need to eat in order to survive. But if you think about margin debt, that could also be used to fund your purchases in the equity market. Again, I'm not saying it's cool in and of itself, because over time it can only ends up badly, but in the short term it's just another form of liquidity added to the market, right? So again, just another fun dynamic, which again on short term could be bullish, mid to long term, it's some sort of a worrying thing for me, right? But again, why it could be, why the logic could be the one that I just outlined? Well, because you see that the risk appetite for households it's never been greater. So again, is it so far-fetched to think that a part of that debt, credit, uh, consumer credit, could have been used to actually buy into stocks, right? Standing to the data at the very least. Maybe not all of it, but maybe a part of it, right? So again, that shows that the sentiment it's still particularly bullish if you still have people willing to take on debt in order to purchase stocks. Now, sure, stocks need to perform very well, otherwise that debt is going to be unwound. But it works until it doesn't, right? What else? Yeah, talking about seasonality, this time around we're looking at the Nasdaq. So it looks like when we wrap up the month of September and we get into October, November, December, we should just be in the best part of the year for the equity market. Again, since August and September weren't at the end of it particularly bearish or weak, maybe we should just keep or bear in mind that the market can surprise. What if the market surprised us 2 months in a row, and now there is going to be a third, just on the opposite direction though. So we'll see about that, I guess, right? And there's really not a lot more on stocks, right? I think at the end of it, overall, generally speaking, we're getting to the end of the month. So what you could see, there are actually maybe two or three dynamics at play. Two of them we hinted at last week, which is, of course, we are in a buyback blackout window. So though we kind of had the possibility of a huge buyer removed from the market, what the market actually didn't care, right? The other one was, we are getting into the part of the quarter, so quarter end, where on one side you might see institutionals, money managers, hedge funds in need to catch up with the best performing assets, just to window dress their balance sheet and then being able to show the investors or the clients that they are actually owning the best performing stocks, right? Imagine you go to your financial advisor, you see the market being up, your portfolio is kind of down, you're underperforming the market, and your financial advisor shows you the composition of your portfolio, and you might think, wait, why do we own so little of Nvidia and Microsoft and Google and Meta? It doesn't make any sense. Those are the best performing stocks. And am I underweighted there? So this is why I'm down relative to the benchmark. Yo, you are my advisor. Shouldn't you be the one which should have acknowledged the fact that I needed to be in these ones if I wanted to perform at least closely to what the market is returning? So that's kind of the red herring that these money managers could face, right? But on the other hand, bear in mind, end of the quarter, it's usually a good time for rebalance, portfolio rebalance, right? So to counter these dynamic I just described, you could also have people which are owning stocks which perform particularly well this quarter. They may be a bit overextended, they may be overbought, or they are now constituting a bigger and bigger chunk of their portfolio. Therefore, they need to cut them back, so to sell a chunk of them to get them back to target weight in the portfolio. So you could see a bit of selling, especially in those sectors which were particularly in favor, right? Same dynamics as usually when you think about portfolio constructions and portfolio rebalancing dynamics, right? So I think overall that would be it for the markets. The tiny thing which could be worrying, as I was hinted at before the pause or the break, is that we are living a situation which to me it's kind of unusual. I think it should be unusual for everyone. But look, this is Bitcoin, right? So you see Bitcoin, and if you look at the level at which it's trading, it's particularly elevated, right? And we've seen in the past that when we reached out into these levels, it was a good time for a pullback. Now, of course, I think we are looking at a 5 years moving average and the corresponding deviations. So there is not enough history on a Bitcoin chart for it. So you just have 3 iterations of it. But we could look at something like emerging markets, right? Everyone now is talking about the AI or the tech sector trade in China. If you're following China as well, you might have seen, you must have noticed that this week that just skyrocketed on the back of the Chinese government preventing Chinese based company to buy Nvidia new chips and all the rest. But we had a huge run in the Chinese and emerging market overall equity market driven by the tech sector, right? But again, even in this one, we've seen in the past that when we start to reach out into these levels of deviation from long-term moving averages, we often do get a pullback or a mean reversion type of a play. Same that we see in gold, which is why, again, as I said you before, I'm trying to take a bit of profits on gold. Now, again, bear in mind, these are monthly charts, right? So they could take a lot to play out, right? And, you just need to be careful when you're looking at such high time frames because the timing of it is always complicated. But nonetheless, you've seen that in the past, those were the dynamics at play, right? And same if you look at the momentum index or the momentum ETFs, which is again another type of ETF which tracks those stocks which are running on momentum, right? Now again, even in this one, you see that when we start to tap into those level of deviations, we often do get a pullback. Uh, it's worrying for me because the trend is a trend until the end of the trend, right? But it's just that everything is going up. Like gold is up, historical highs. Equities are up, historical highs. Uh, I just get that feeling that when when something actually breaks and you have that drop, which again, it doesn't have to be uh, a 1929 style recession or depression. And it doesn't have to be a 2008 type of a crash. It doesn't have to be a dot-com bust. But at a point we're going to have another 15 to 20% recession probably next year at this point. But when we have that, you don't get that type of a rotational type of behavior, right? It's not like money are moving out of stocks and they're now bidding gold. Well, I mean, it could happen, but gold is overbought too. So if you have to the risk, uh, you're basically overextended all across the board. So maybe you don't want to buy into gold at these levels because you just think the risk reward is not there. So it looks like it could become one of those instances where the real safe haven it's actually cash, right? So that was the final note, the final warring type of a note in between this massive bullish sentiment and euphoria, right? That being said, again, bear in mind those are monthly charts. It could be another 3 6 months, we don't know. It's just to show that historically things can only keep up that type of pace for a defined amount of time. At a point, a macro pullback is kind of due. Right? It's the history of mankind. It's always different this time, up until the point you do realize it's not. All right. And the prevailing truth, it's that market don't move in a straight line. Whether you're looking at a 1 minute chart, whether you're looking at a monthly chart, right? So always keep it in the back of your minds when you take your financial decisions, right? And with that, I'm gonna wrap it up. Wishing you all a very good weekend. Luckily, the weather it's on my side this weekend, so I'm going to enjoy a bit of sun outside. And as for you, we're going to talk back next week. And up until that point, be nice and be cool. Niels out.
Mm-hmm. Mm-hmm. Mm-hmm.